All right, so as we delve into market structure a bit more, we've checked out the demand supply levels, support resistance levels. We've checked out the Fibonacci. Now, there are two more things I'd like to show, which are gaps and pivots. Obviously, the swing days and the swing hours are important, and you're going to be looking out for those as you get that information from the members area, or if you take the coaching, you'll calculate them on your own. Okay, but the important thing to add are gaps and pivots. So let's take a look at what gaps are. Now, gaps are basically known as price gaps, and they can happen at any time frame. And here we have a good example. This is the SP 500. So here, for example, this is the low and this is the high of this bar, and in between here, as you can see, the market has not tested any prices at all. So all of this up to here is a gap. Now, why is this important? Because the market doesn't like gaps. The reason gaps occur and they want to fill them in is to make sure that the market is giving a fair value. So whenever there's a gap in the pricing, the market would like to come and fill it in. Okay, like it's filled in the gap here. Now, it doesn't have to be automatic. It doesn't have to be like straight after. But whenever there's a gap, it fills it in. So for example, there's a low here and there's a high here, and in between there are no wicks. There's nothing to close this gap. So as the market comes back up, you see, it closes this gap. As it closes it, it sells off. Okay. Now, why is this important? Because if I have a direction, the market will want to come and fill it in. So if I do want to get into a sell trade again, I'd like to wait for gaps to be filled and then sold off. Okay. There's also a gap here. You can see that too. We have a difference between these levels here, as you can see, and this is a gap. So the market will sooner or later want to fill in that gap. Okay, if you take a look at anything, any asset, you can find them on the euro dollar daily as well. For example, let's take a look. As you know, the daily for us is important, and market likes to fill in the gaps on the daily. You can see there's a gap here between that low and this high here. The market wants to see all kinds of wicks closing gaps. You see how they're closing gaps all the time. They're filling in every price level that is there, so that we have an understanding that this is fair value. Also here, you see there's the wick there, and the high of this bar is here. So this whole thing is a gap here. The market will want to fill it in. And the whole idea of having this Fibonacci here is we'd like to see the market come down, and 37.5 for us is a great level. But when I see gaps, I want to be thinking twice and thinking to myself, well, okay, this is great level, we'd love to buy here, it's a real discount, but there is a gap here. If the market fills it, it will come lower. You can see there's a gap here between this bar and this bar as well. This is a gap. So if the market comes back and fills it in, we can find ourselves all the way back here again. So it's important to understand that there are gaps in the market, and they do want to fill those gaps in. This will help us especially to measure the retracements, to look out for the swing days once the gaps are filled, and trade more effectively and efficiently. Just like with the daily, it'll be important on a smaller time frame as well. So let's, for example, take a look at gold. This is the 4-hour chart. Now look what happened here. This is most recent. You see how the market went up, and they've just closed that gap there. Okay, pretty much that gap, whoops, is pretty much closed. Okay, so the market will want to come back, retest these levels, and then trade accordingly. That's a 4 hour. The same thing with a 15-minute. Okay, as you can see. And also on a 15-minute too, you can see the market's kind of gone up from here. See what's caused the up move? It's this red bar here. Okay, so that's caused the market. I'm taking the lower the wick of the blue and the red bar here. So that's the zone. All right. And what has the market come down into? It'll probably be a Fibonacci level. That's a high. And that's a Fibonacci level right there on your 50. And like I said, on the 4-hour chart, it just filled in that gap as well, pretty much. Okay, so knowing these, noticing these little gaps and levels is really important, as they will help us not to get stopped out. And even if my timing, for example, let's say my timing is, let's do this. Okay, let's say I want to go long, for example, and my timing is here. If I see a gap, I might want to wait, because the market usually fills it in and then turns around. Okay, so these things are very important. They'll give you a heads up and we'll get the time right and the market will turn, and then but it will push for us for a gap fill and things like that. You need to keep in mind. Now here as well on the small time frame, you can see that and that is a gap zone here. Okay, and this is the resistance, so that's pretty much the market coming in for a good buy kiss on the small time frame before taking off. Okay, let's take a look at a few more and not be lazy. Let's take a look at NASDAQ. It'll be the same kind of thing. This is a 15-minute chart. Let's see the end. Now as the market is heading up, you see how nicely they dropped it down beautifully, and now they've filled in all the gaps. There's no gapping here. You see, that's healthy. This is really healthy stuff. There's a big gap here, as you can see. So the market will want to, if they go up, they'll want to come up into this zone before thinking about selling. And if we come up into this zone, what should we keep in mind? Well, if I have a zone, do I have a gap above that zone? And we do. And here as well. And just a little bit here as well. Okay, so the market can actually, now if I turn this into maybe an hour's chart, okay, to a 1-hour chart, that's going to look better for us. Okay, so the market has got room to kind of come up before selling off in this zone. And obviously you can see a gap here on the 1-hour chart. So sooner or later we're going to have to come up into these zones. Like I said, it doesn't have to be immediate, but sooner or later it will. And if you take a look at NASDAQ today, today is the, let's take a look at today, shall we? On the, let's do this. If I refresh, and if I do 31st of March to the 4th of April, you see NASDAQ is Monday, all right? Dow Jones is Monday. So the market is looking for a swing day on a Monday, and that's a nice little push down to come back up, and we're in US morning session here. So in a situation like this, for example, if I go to the daily, I'll be thinking, well, wait a minute, they just filled in a gap. See the gap there? So that's a gap fill. It's a swing day. So now I can say to myself, well, let's go into a 15-minute chart and take a look at the hours on Monday. I got 5:25 to 5:55. 5:25 is on that bar. Okay, so 525, that's 555 is right on this bar, and the other hours are needs care until 6 o'clock, so I need to be careful here until 6 o'clock. That's 6 o'clock here because this is a 15-minute chart. And then I'll add in the other hours as well. What have I said here? If it finds direction, it should continue to 9:30 and possibly to 11:30. So I have to be mindful. Buying this zone is okay. And then if it does, maybe I'll go to 9:30. If it gets to 9:30, then maybe we can come back into 11:30. Okay. And if we find a low on a Friday, on a Monday, which is today, okay, then today or tomorrow we could look to go long, and there's gaps here and the market is down, so going up a little bit should be okay. It should give us at least enough to cover the trade. Okay, now if I was to enter a trade here, I'd put my stop loss where? Just under that level there. Okay, so if anybody entered the trade, let's say here, your stop loss should be just there or slightly under there. All right, at the end of the day, this is how it is. So that's a tight stop loss. Where should I be heading there for? If I enter the trade here and that's a stop loss there, I want to at least break above that. Okay, so once I break above this, then we'll want to fill in the gap here. You see the little gap there? So the market should come up into that zone, and then we should come up into that zone. Okay, so now I've got targeting as well. So for this much stop loss, okay, I've got initial target there, further target all the way there, and then I can check to myself, well, when is the next swing day? So if I also know the next swing days, right, for NASDAQ, which is Wednesday and Friday, so maybe we'll go up into Wednesday, sell Wednesday, pull back into Friday. Okay, so that could be like a Wednesday, Friday. Okay, if the market wastes time here until Wednesday, then Wednesday will be a good setup to push up as well. Okay, I hope that makes sense. But at the end of the day, this is how gaps are used. You can use them as a target as well. Another nice thing is pivots. Okay, pivots. Now I've got them on my MT4. As you can see, I've got a daily pivot here, which is the purple, and the weekly is the aqua. Now these levels work out fine as well. All right, and these levels are good for us to kind of trade off, especially on the intraday. And the weekly is actually a good level when the market is kind of like retracing to go back up, or if it's broken, you can go up into a weekly pivot and then follow it down if it matches your trading hours, obviously. So we're always wanting to match time and price, remember. So having these levels, the daily pivot, the weekly pivot, and also the opening price, the white lines here, you see all of these white lines here like a ladder. This is the opening price, and the purple is the closing price of the previous day. The green here is the high price of the previous day, because if I have a breakout, you know, I'd like to come back for a good buy kiss. Remember, this is like a break of structure. So market coming back into the high of yesterday, or the closing of yesterday, and you know, going up, or the opening of today, and then going up at the trade hour. That happens often. Okay, so those are levels I'd like to use, and obviously the low of the previous day as well, because the market is going up. Sometimes they'll come here, stop sweep, and then keep pushing up. So those levels are really interesting and useful if you're trading as well with time. But if you don't want to have a bunch of lines on your chart like I do, then you can just leave it blank and just draw your own lines, and that's also just fine. It's just doable. Okay, not a problem. And you can just use demand and supply or Fibonacci and gaps and kind of manage your trade that way. Having time obviously is like is very, very important, because it just allows you to get in at the right time at the right price, and that's it. So once it matches your technical analysis and you want to get into the trade, and that's minimal risk, and you've got some maximum return approach, you also know the next swing day. So if this does go up, it's got a potential to go up all the way into Wednesday. Okay, so you really have a lot of potential there, which you can follow through. All right, so I hope this session helped, and what you can do now after this lesson is to look out for a lot of gaps and see how the market filled them in. So go back to charts and really investigate and see, because your eyes will want to get used to see how the market is making gaps. They'll want to come back and fill these in later on. So sooner or later the market is going to get back up, and if you see them, if you see these levels, then it's really going to help you out later on, because you're going to understand, okay, we've got room to go up, we've got room to come down. So obviously gap fills are very, very important. See how it fills in all the gap. It makes a fall and it just goes back up and keeps filling them in. Here as well, look, a gap fills it in and then goes back. So here as well, it has filled this gap, look, see, just touches it and then bang down. So all of these gaps are like important, so you can pretty much see and evaluate like how effective that's going to be. And if you're short and let's say you went short here and there's a big gap here, right, you have to understand on a smaller time frame, sooner or later they're going to come back and fill this in. So make sure your profit targeting is good, because they're going to come back and close it. Okay, then on a swing day, maybe you might want to go up, like today with the Nasdaq. All right, it's a swing day today, so we're at the lows. New York morning session, yeah, let's do it. We just closed the gap. We've got a bunch of gaps up here. I can take it up for a day or two into the next swing day, Wednesday, and then sell it off again. By trading with a small stop loss and a relevant hour, then what I'm actually doing is minimum risk and maximum return. All right, so do a lot of exercises, really get in there. It really helps you to train your eyes and become really good, and then you'll be able to spot these and match the time, and it'll be like bang in and bang out. You'll be all over the markets.